Okay, actually, start getting into what we talk about. We want to plan this. It is go through the previous things. So, can you hear me? Those who are joining online. Good morning.
Good morning, sir. Yes, we can hear you, sir. Thank you.
Okay. So we are going to start the session. Even though we have two students here, physically, right? So we will discuss various what we talk about. Can you remember what we talked about in the last day? We start the discussion of the macro economy. Right? Yes. So what we talked about last time, we understand the nature of the macroeconomic. Basically, what does we are trying to do under the macroeconomics. Basically, the macroeconomics as we highlighted in the previous discussion. You may remember we talk about the overall economic behavior. Basically, two things we are going to discuss, no? Under the macroeconomic theory, basically explain the behavior of the economic aggregates and the averages, no? So we understand what are the economic aggregates and the averages, no? So that explains generally the overall economic behavior. Unlike in our previous discussion in the microeconomics, we talk about the individual behavior, no? So they actually in our basic initiation, we discussed about the consumer behavior part, no? So we are discussing the producer behavior part as well now, right? That is the business economics. So basically macroeconomics, when we are talking about these economic aggregates and averages, no? That in averages mean those are the prices, no? Basically. Aggregates are the basic macro variables which cover overall economy. Right? So in macroeconomics, we identify the economy as a set of macro variables, no? Comprised. So when we are analyzing those variables, we can understand the overall economic behavior. Right? So basically, as we discussed, it basically talk about the when we talk about this behavior. So it analyzes the what are the factors that determine those variables and that mean economic aggregates and the averages, and they are the relationship. That's also very important, no? Right? Because unlike microeconomics, these macro variables are actually closely interrelated. Right? Therefore, when we are analyzing the relationships, since there are some set of macro variables, no? Right? Which explain the overall economic behavior, those variables are interrelated. So when we are trying to control the macro variables, no? Right? Because we need to achieve certain goals, no? Right? In economic goals, we understand. So when we are trying to achieve those goals, so we need to control these macro variables. When we are controlling those variables, one variable it will affect the other variable as well. That's why different people in even economics there is no common explanation when we are explaining particular thing. No? Right? There can be different ways and means of analyzing those relationships because it's very complicated. No? Right? Relationships is basically we talk about the growth and it affects inflation, unemployment, no? Supply, exchange rate, all these things are right. Those are the affiliates and average. Those are interrelated. Therefore, it's create some kind of complexity when we analyze those behavior, right? So we must try to maintain a trade-off with behavior, kind of balance. No? That's why we here also we talk about macroeconomic equilibrium. So why we need to maintain equilibrium situation because these variables are normally will behave in a different way. No? So we need to analyze those behaviors and some kind of relationship, stable situations we need to maintain among those variables. If we can maintain that stability, that is we identified as the macroeconomic stability. So maintaining stable stability of the consumption, maybe investment, expenditure, interest rate, inflation. No? Maintaining certain level of stability is very important in order to improve the business sector, especially if you are trying to achieve the economic objectives. So actually, even though that comes under the individual's point of view in the very beginning, consumers, investors, those are the savers like that. So in finally, their overall behavior affecting the economy. So therefore, we are trying to explain those relationships, right? So basically, we are going to look at what factors determine, right? Those variables, and the relationship, and also trend over the time how those variables are behave over the years, over the long term. So the long term understanding the long term behavior also very important, right? So we can then predict, right? So in future and so on, right? So that's very important, right? Now, so that is the basic thing we discussed in the last time, right? We talked about the macroeconomics, right? We have to do different things as well, right? So basically now we talk about the macro, right? Underlying those under the basic idea, right? This is explain the overall economics, right? And we look at the behavior of the in the last years, not right? When history, right? Right? How those behaviors are behavior. So when we explain those behavior, fluctuate up and down, so right? You can associate it with those changes. The domestic economy may be the external economy. So that's also very important, right? So when we are talking about this behavior of the macro variable, we need to concern not only the internal economy, external economy also very important behavior, right? So that's a kind of overall economic behavior, right? When we are talking about the overall economic behavior, this micro environment and the macro environment is very, very important. So under the macro environment, we can talk about external environment, external economies as well. So there are those changes in the external environment, maybe the prices, right? And maybe the other improvements will affect the internal economy as well. So when we are talking about those behavior of the variable, so we need to consider those external factors. Otherwise, we cannot maintain stability in our economy. If you are trying to inflation, stability by making the prices, right? External, external environment also affected, right? External prices in there is a kind of economic price, prices, financial prices, economic price. So we need economic prices, right? So time to time it's happened, right? Yeah, if we are explaining those behaviors, so we need to take into account those environmental, external environmental factors as well. Right? So we can actually, other thing is we can relate with the policy changes because as I mentioned, those variables, macro variables, we are going to manage by implementing the policy. So that is the other side of the macro economics we are talking, right? Because we are, once we look at the behavior of those variables and the macro economics and also the policy, how we can design and implement, develop the policies to maintain to control those variables. That's a very important part of macroeconomics. It's a policy analysis. So that's unlike micro, we are not talking about it's not microeconomics. But here, so we need to talk about the policy. Macroeconomics are mostly focusing on the policy. Basically, right? So there's a part covered under the analysis. We look at the behavior of those variables, what kind of factors determine those variables, and those how these variables are related and how these variables are changed over the time, right? So that you have a kind of understanding about the behavior of those variables. Then policymakers can design appropriate policies by looking at those things, right? So there's a fluctuations, there's inflation situation, appropriate policies, we need to adapt, contraction and fiscal policy. Right? We need to control the inflation, right? Likewise, right? So it's macroeconomics basically covers the policies and it's a policy analysis. In economics, the policy oriented part in economics, coming under the macroeconomics. That's very important, no? Right? Policy-oriented farming economics coming under the macroeconomics. Not only we are going to look at analyze the economic variables, but also we look at how the policies can implement in order to manage, control those variables, and thereby to achieve the economic objectives. Right? So, because the final of the target is our target is to achieve economic objective. Right? How we can implement the policy to go to that target. Right? So that is the other aspects of the macroeconomics we are talking. That's why we need to look at all these fluctuations, then the policies can be developed based on that. You know, right? When we are developing the policy, we need to look at the past, right? How those behaviors happen. We need to focus the future as well, no? Right? By looking at those two angles, no? Right? Current and the future, the past, no? Right? You need to design appropriate policies, right? So that's a kind of holistic approach, no? Right? So macroeconomic approach is a kind of holistic approach since we are further about all these aspects, right? So that's why we look at all these things, no? Right? We last day we look at the behavior of these variables, no? Right? These variables change over the time, right? Okay, we talk about those things, right? So when it comes to the now today's discussion, right? Now little bit we talk about the historical things, starting point, and we are not going to look at in detail, right? Just to give you an idea, right? Now macroeconomic starting point, no? Do you know who is the father of macroeconomics? Don't make up. Keynes. So we call it as Keynes, right? Is it? Actually, why we identified this economics as a mother of macroeconomics? Because that was happened in 1920s, no? Right? Because now earlier now we talk about now the demand, supply, all these things, no? Right? Demand, the micro point, no? Right? So until 1930s, this micro analysis is very popular. Right? So those economics basically coming under the classical economics. Most of the classical economics explain their approach is microanalysis. Microeconomics. By looking at the individual's behavior, we are trying to analyze the economy, right? But that was happened in the early economics. Those economics we identified as the classical economics, right? Okay, right. So even before that, we can talk about, right? We should talk about the history, right? Just to understand the starting point of the macroeconomics. So it's coming under the on Keynes. He actually published a book, right? Revolutionary book, right? That is his invention, right? So that is called, what is the book he published? The General Theory of Employment, Interest and Money, right? That is the invention he made, right, by analyzing the economy at that time. So because there is 1920, there was a great depression in the world economy, downturns, no, right, in the world economy. And that also we experienced very similar recently under this social COVID situation, no, right, crisis, no, right. So kind of situation happened took place in 1920s as well, right? So actually, since there is a downturn in the overall economic activity, that actually creates unfavorable situation, right? So the microeconomic tools that we explained earlier, microeconomics, talking about the resource allocation, individual behavior, that kind of analysis not support to explain the situation in 1920s to get rid of that, to solve those problems. Because there is a low growth rate where the economic output is declining seriously, unemployment increase, investment increase, like that, you know, right? Because the recession period, what are the risk symptoms, no, right? So output decrease, income decrease, no, unemployment increase, investment declines, no, like that, you know, but some sort of inflation, price level, accelerations, so we see, right? So that kind of situation, in order to address the situation at that time, is classical economics. Now, Robbins, Adam Smith ideas, they say, no, right? Those ideas are not supported. market analysis, market forces, explaining the market forces, individual behavior, that analysis is not support to explain this situation to prevail in 1920s under the Great Depression, right? So therefore, now that actually should be explained by analyzing the overall economy, right? So John Maynard Keynes, he has look at the overall economy, right? By actually his into this invention, right? His book, right? That explains the general theory of employment, interest, and money. That basically explains how the output is determined, how the employment level is determined, how the interest rate is determined. So that kind of explanations is first time introduced by the John Keynes under his the book, right? So that explains the kind of analytical model, right? National, that is called new national income determination model. How the output is determined, and associated how the employment, interest rate, those things are determined, right? So that gives some sort of approach, right? New idea to explain the situation at that time, right? And to solve such problems. That basically coming under the demand side analysis. Now the Keynesian analysis, Keynesian, right? Keynes is the originator, right? Keynesian means who are the Keynesian? His followers, right? Once the Keynes started with this discussion, right? Some other economics also follow, right? So those are generally identified as Keynesian economics. Right? So the Keynes died in 1958, right? So from 1936, he invented this book, right? So later on, actually, those ideas, other economics popularized, right? So we call it as Keynesian. So that's why we developed Keynesian theory based on that, right? That theory basically explains the demand side. By analyzing the demand side, how we can explain the problems in the economy, right? Because Keynes and his followers believe demand side approach is very important, right? Rather than the supply side. Now economics generally we divide it into two parts: supply side economics, demand side economics. Yeah. Okay. So this Keynesian theory was first time, right? So analyze demand side, rejecting the supply side. Against the supply side economics. Basically, supply side economics are the classical economics. As we discussed now, we know that Adam Smith, right? He talked about how the wealth is determined under the wealth of nation, right? Basically, that's a kind of supply side analysis, right? So why we say it's supply side? Because he explained how the wealth. Basically, it explains the factors of production and the technology, right? So the productive capacity determines the country's wealth, right? So that means the factors of production and labor capital, entrepreneurship. Those are the factors that determine the output, right? So that's basically explained under the wealth of nation together with the technology, right? All these elements are supply side factors, right? In order to increase the output, supply, there should be the improvement in the factors of production. That's why we explain under there should be expansion of the productive capacity, right? So that basically classical economics explain supply side analysis, kind of supply side, right? Supply side factors are important in determining output and employment. But rejecting that idea, first time, the Keynes explains not the supply, demand side analysis. Factors are very important in determining the output and income. That's why we identify the Keynes asset and its followers as demand side, right? Now his invention to analyze the economy, that model is called general theory. General theory. So they are under that they develop a new model of income determination, national income determination. That's the one we are going to discuss. So that's why we identified aggregate demand, right? Demand. So this explanation, aggregate demand. Aggregate demand comprises major variables: consumption, investment, government expenditure, exports, imports. All these variables are not the supply side factors, demand side factors, consumption, the demand side, investment, demand side factor. Government expenditure, demand side factor, no, right? So that's why we call it as a demand side analysis. So earlier version is under the classical economics, right? You know how to take the whiteboard. Take the whiteboard here. Okay, right. So now classical economics, no, right? So those are the classical economics. Talk about the supply side, but even what way So now you can see the we talk about this gains here, right? Gains And before that, now the Keynes ideas basically originated against the classical economics side, right? Right? So the classical economics, they talk about the demand, supply side, yes, right? So why the supply side factors are important, no, in the economy, output and influence. Think about importing and then desktop එකට අරකට ගියාට පස්සේ මෙනි වීඩියෝ කවුන්ට් එක දැන් ඒක නැතිනේ මේක මේ ඕපන් කරලා තිබ්බේ ඒක තියෙනවා නේද කියන්නේ මේකේ blank page එක මේ lines ඇතුළු මේක ලියන්න පුළුවන් මේක ටිකක් slow වගේ වෙන්න මොකද මේ ලියන්නේ එක fast එකක් වෙලා ඒක කොහොමද වලදී පොලි රේස් කරනවා Okay, right now when we talk about now the Schroedian theory, so we talk about this evolution. Right? Now, firstly, I can identify the now we talk about now the Keynes. Keynesian, right? It's very different, right? So moving. Now we identify the Keynesian theory, basically explain the demand side, no, right? So that kind of demand side analysis, right? Keynes ideas, actually demand side analysis, how it originated through his book, General Theory, right? General Theory of Employment, Interest and Money in 1936. That actually explains how the output and employment is determined by the economy. We talk about the background behind that, right? 1920s, what happened? Right? It don't solve those problems for the Great Depression period. Keynes originated, Keynes and his followers originated, no, right? He explained kind of demand side analysis, right? In order to get rid of those problems, right? In 1936, through his books, General Theory of Employment, Interest and Money, right? That actually explained the model, right? So that model is model of national income determination. Sorry, I can't write it here clear. I don't know, right? Performance very weak, right? Model of income determination, right? So that's basically explained through the aggregate demand, right? Aggregate demand, right? So the model basically identified the main factor, the aggregate demand. That's why we know that aggregate demand is C plus I plus G plus X minus M, no, right? So that is all these variables are explain the aggregate demand, consumption, C, investment, government expenditure, X mean export, M mean imports, right? So all these variables are demand side factors. So that's why the Keynes analysis is demand side factors. Because in 1920s, what happened was there was a Great Depression, right? There was a Great Depression, right? In 1920s, no, right? Starting from 1920s, right? So Because why there is a Great Depression, Keynes identified as there is a deficiency or shortage in demand. So, shortage in demand. Why the shortage in demand, right? So that is the main factor that goes to create crisis environment in 1920 because of the deficiency in demand. Right? So therefore, Keynes, that's why the Keynes suggests there should be encouragement of aggregate demand. Itu very current, not the supply. So that's why he proposed a model of income determination, right? Through his model, he explained the importance of the aggregate demand side factors, right? In order to address the problems in 1920s. So the Keynes analysis basically explained the demand side factors. Before that, actually, this was in 1936, no? We talk about the classical economics, right? Classical. So those economics explain the supply side factors. Partly we talk about the classical economic, this microeconomic analysis, those economics. ABC, Alfred Marshall, right? David Ricardo, demand explanation, right? So all these economics are supply side economics, right? Adam Smith, right? These economics explain the supply side factors. They highlight the importance of the supply side. So that's why in the Adam Smith Wealth of Nation, right? They identified the factors of production and the technology. All these variables are supply side. Now rejecting this explanation, main idea is you may remember according to the now BSAA, right? We explained the sales law, right, of market, right? So market mechanism, right? Right. So this actually basically this theme of the this classical economics is supply creates its own demand. Supply creates its own demand. Problem is the supply, right? Not the demand, right? Supply creates its own demand, right? Because problem is supply at that time. You know that before 19, even 30s up to 1930s even, right? This World War situation and so on, right? Basically all the countries collapsed, no? And people try to increase the output, no? Right? Because world output also decreased at that time. The world economic situation, no? Right? So therefore, people look at how to increase the output, employment, right? So they believe now the supply. There is a problem with the supply because all the countries collapse, right? Destroyed, right? Under the World War, right? So that's why they come up with that, right? Supply side factors, right? So that the ideology is supply creates on demand. If there is a supply, there will be a demand for that. No? Other problem is the supply. Problem is the output, no? Right? Because output, world economy, the output also the problem will create, right, at that time under the world situation, right? So that's why this ideology came. Before 1930s, actually, most of the economists talk about this micro-analysis coming at the classical economy. So the macroeconomics start after 1936. Before 1936, mostly we talk about the microeconomics. So after 1936, with the introduction of this general theory, people look at the overall economy, kind of overall economic analysis. So the macroeconomics started after that. So that's why we identified the Keynes as a father of economics. So before that, actually, now the classical basically talk about this the importance of supply side factors, how they develop their ideology, right? Based on the mercantilist ideas, mercantilist. Mercantilism. Mercantilist means they are the people calling basically trade, associated with the trade. They promote the trade. So that was happened, that was prevailed in 16th, 17th centuries. 16th, 17th centuries. 16th, 17th centuries, there was an ideology called mercantilism. Basically, they believe that trade is important mechanism. So that's why we are not very good basically, right? At that time, with the associated them, right? So because they want to trade with other nations. So that is basically the basic method they use. By trading, they are going to empower them. Right? So this mercantilists talk about how to develop powerful nation. Powerful nation, right? So what is the strategy? They suggest international trade, right? In order to develop a powerful nation, they suggest international trade. Trade is the weapon that we can use. So that's why we also outside the British, Portuguese, rules, right? Because people trade, right, with other nations, actually not the fair way, right? Unfair way, right? So they suggest, in order to develop a powerful nation, export more while discouraging imports. Basically, right? By exporting, encouragement should be given to the export while discouraging import. That's kind of strategy they use, right? Through that way, we know that they can develop a surplus, no, in the balance of payment, right? So that surplus can be employed to acquire precise metals, gold, silver, copper, right? There are all that you say that they many right? There are all right? Very right. So that is the basic idea, right? So in order to develop, they talk about how to develop powerful state, powerful nation, right? So in order to develop powerful nation, the ideology identified by the merchant is international trade, encouraging exports, discouraging imports. In order to discourage the import, there should be a government, right? There should be a government. Government should do some kind of restrictions, impose restrictions in order to discourage import, right? So the government interventions also highlighted under the mercantilist, right? So that is the basic idea. Now rejecting those mercantilist ideas, classical economics believe classical ideas develop, right? Based on the market, right? Market mechanics. There is no government, right? The classical economics rejected the government intervention in the economy because they believe the free market, right? We talk about under microeconomics, right? Free market, right? There is no government intervention, right? Now, this classicalism totally reject the government intervention. So, based on that, they develop their own ideology that explains the supply creates its own demand. Supply is the most important factor, right? So, that cause to the problems, right? So, therefore, countries need to expand the productive capacity of the country over the time. Right? So, that's a kind of different analysis. Rejecting this idea, the Keynes developed another idea. Right? So that actually, this version changed with the Keynes. What is that? Now we are going to change the demand creates its own supply. Demand creates its own supply. Right? So the Keynes, now the classical version, supply creates its own demand, changed by the Keynesian version, right? So that version explains demand creates its own supply. Demand is the important factor, not the supply. If there is a demand, we need to encourage the demand, right? Aggregate demand. So that's why Keynes believe raising the consumption, raising the investment, all these factors are demand side factors. Keynes particularly identify this government expenditure, right? So there should be a government, right? Now, earlier classical economy rejected the government intervention, but Keynesian theory again highlighted the importance of the government activities in the economy, right? Because fiscal policy, right? Government should be there, right, in order to raise the aggregate demand. If there is a decline in the private investment, no, we know that there can be some reduction in private investment. Because so, can we see that's the main factor that was to create crisis in the economy, right? If there is some reversal of private investment, no, right? Economy goes down, no, right? That main crisis, no, right? Because this private sector investment is believe is highly volatile component, right? Investment is the highly volatile component. So that may cause to the aggregate demand and the output of, right? So therefore, in order to, in such situations, in order to control the aggregate demand, there should be a government. So government raise expenditure, right? If there's some reduction in private investment, government should be there, right? So the government can raise the expenditure, right? Pump the money to the economy. That's the model we used the last time also, right? And previously, sometimes it may raise the government expenditure, right? If there's a crisis, right? It's another factor, right? So that's why the case video, there should be a government intervention is very much important in this model, right? So you can see the different arguments, right? So the work countries believe the trade, right? But they are different from that, right? Trade is something giving more encouragement for the exports, export promotion, and so on, while discouraging imports. But they are also highlight the government. But here the classical economists, they don't reject the government interventions. They believe the supply side factors are important, developing output and employment. So that's the supply is on demand. But Keynes rejecting that idea, Keynes developed the demand side kind of analysis, right? By explaining the prevailing situation at that time. That explain the demand side factors are more important, no? In explaining the output and so, right? So therefore, now we see, right? So that's a kind of evolution of economy. So the macroeconomy is starting from here, right? And later on, after 19, now this was up in 1930s, 1950s, 1970s. What happened? There was a great inflationary pressure in the 1970s, right? Now the 1970s world economy, the prices increase. Prices are upward trends that create inflationary situation in the world economy. Right? So now the Keynesian analysis, demand side analysis, controlling the aggregate demand, that is not supportive in that sense. Because if there is an aggregate demand, if we raise, what happens? That will pull the prices, right? So therefore, different kind of economics came across, right? 1970s. Those economics we identified as what is called monetarism, monetarist, Mulyavad, no, right? Monetarism, right? The Milton Friedman and his followers, right? They believe the money supply, money is the matter. So that's the point in 1970s. Before that, we did now the Keynes also talk about the money demand, right? But we explain the real impact of money demand on the in determining output or employment. This analysis talk about only the demand side, the real factors, right? Demands. But the monetary factors are not taken into account, right? Even though money is there, right? But now, first time the development of the monetarism, Milton Friedman and his followers, right? The monetary is the starting point, it's the Milton Friedman. You sometimes hear Milton Friedman, right? Milton Friedman, right? So they believe the money is important, right? Controlling the money supply is important in determining output and employment. So that was took place in 1970s and on. Right? So that actually controlling money there should be a systematic growth in money supply in order to address the inflation situation. So the money, their impact, the short run and the long run impact analyzed under the monetary, right? So that was about 1970. When it comes to 1980s and so on, the new growth theories we talk about, right? Some kind of endogenous growth theory. So that's another class of economics. Like that way we see some developments over the years, right? Economics mostly work, right? So the macroeconomics ideas came into this way after 1930s and on. Right? Okay, right. So we talk about that one, right? So this is just for your information, right? General theory, employment, interest, and money, right? And the ancient theory basically analyze the demand side factors, kind of demand side analysis. The model used the national income determination model and explain basically the ancient theory. We are going to look at that one. Okay, right? So now we identified the major macro variables, right? So now the demand side analysis, right? You know that aggregate demand comprises basic variables, right? So they are actually we see the investment, consumption, those variables, right? When we analyze the major macro variables, right? Economics, we identified macroeconomics, we identified major 5 macro variables. So when we are explaining the economy, right? Following the ancient theory, right? We use these variables. Now the consumption, investment, money demand, money supply, savings. Now the consumption, investment, savings. So those are the now economy when we now, as I told you, right? In macroeconomics, we are going to talk about the overall economic behavior. Right? So therefore, we need to identify a set of variables which explain the overall economy. Now here, basically, we identified the two sides, two variables, real variables and the monetary variables. Real variables and the monetary variables. When you explain the economy, kind of real sector is there, monetary sector is there, no? Right? Now we are talking about the money market, capital market, also monetary sector. Basically, the money is the matter, right? Parts. Right? And the other side is the real sector. So the real sector variables explain this consumption, investment, savings. Those variables explain the real sector. Money demand, money supply explain the monetary sector. So we can identify the economy. So economy we divided into two sectors, real sector, monetary sector. Right? To take the economy, two sides, real sector, monetary sector. Real sector explain the consumption, investment according to these macro variables and the savings. We know the consumption. According to the Keynes, consumption mainly depends on the income. No? Investment depends on the interest rate. Savings also depends on the income, right? And money demand, money supply, those are the monetary variables, right? So that actually determine the interest rate, right? Now, okay, right? Now, this is the kind of economy, right? We identified as the real economy, real sector, and the other one, financial sector or the monetary sector, no? Right? Monetary sector, two sectors, no? Now, the real sector, as we said, basically we identified the consumption, investment, and the savings, right? So this real sector determine the output level for the income, right? Money demand and the money supply, right? MD is the money demand and the MS is the money supply. So that actually determines the interest rate, no? Right? So the real sector, the final outcome is the output, no? Right? Right? Production. So that we identify as the income, say, right? Mean the production total output, no? Right? Equals, no? Right? We denote it as Y. So that is the output or income. So there is a real sector final outcome is the income. Finally, we are going to explain the determination of income in the real sector. Monetary sector, financial sector, the forces, money demand, money supply, those are variables that determine the interest rate. We know that money demand in the money market, we identify the money demand and the money supply. That determine the interest rate. Okay. So now, as I mentioned earlier, right? So monetary variables, these macro variables are interrelated. Here also we see the same interrelationship, right? Real sector and the monetary sector, right? So there are those sectors are, we cannot explain the behavior of the real sector, right? Or the goods market, no, right? Goods market, right? Without explaining the financial sector. So financial sector, the changes will affect to the real sector affect to the financial sector as well. That's how it is. Now the Keynesian analysis basically explain this real sector. Keynesian, right? So now the Keynes explain the basically aggregate demand ADAS model coming under that. Aggregate demand comprises the Keynes explanation effective demand, no, right? Effective supply loop. So that actually T plus I plus D, no, right? In a closed economy, no, if we go to the open economy model, we need to export and import. Right? It's a closed economy. That's a closed economy. We had export and import. That's open, right? So this is the explanation. Keynesian theory basically talk about this consumption, behavior, investments, savings, and we talk about the money demand, money supply, money demand, those things. But in explaining the output, right, we basically look at the demand side factors coming under the real sector, real level, right? Now, ignore the, now we identified the relationship with the income and the interest rate, but in explaining the output and employment, Keynesian theory ignored the impact coming under the interest rate. Right? So, in other words, he explained how the aggregate demand, how we can increase the aggregate demand, right? Simply, one way is by raising the government expenditure, right? How those expenditure is financed, not explained under the Keynesian. Finance side is not explained. Consumption, we explain how people they get money. Those things not explained. Investment, I explain as a variable, but how this investment is financed, not explained. Government expenditure also explained, but how this government expenditure is financed, not explained under Keynesian. It's a kind of one sector analysis, single sector analysis. By looking at the real sector only. But ignore the monetary sector, right? So, right? So that's for the time being we can take, because we need to understand that, because later on we actually going to more developed model we are going to explain, that is called ISLN model, right? Kind of analytical model that incorporate these two sectors. Right? Because we need to incorporate our target is to explain the overall economy, right? So we need to explain both the sectors together, right? So those sectors are interrelated, right? So that's very important. But in the Keynesian theory, only look at this real sector only in explaining the output and supply. That's the weak point, right? You can identify, right? So in order to explain the overall economy, we need to incorporate real plus the monetary sector. That is happen, not the theory in analytical model called ISLN model. Okay, right? So that's the Now, we are going to look at the Keynesian theory, these aspects, right? Okay, right. Now we identify the real sector and the monetary sector. Real sector determine the output, no, for the income. Monetary sector determine the interest rate. And you need to remember there is an interrelationship between these two sectors. When we explain the whole thing, right? But Keynesian analysis only look at the real sector only. So is income determination one, right? Right. So then we are going to now still we are in the introduction part, right? So now as I mentioned earlier, right? So I mentioned that in macroeconomics, not only we are going to analyze the variables, right? We are going to look at the policies as well, right? At the beginning I mentioned, right? It's a kind of policy analysis. So scope of the macroeconomics, basically we can look at in the two approach, two sides. One is it's a kind of economic analysis. Right? Why we say it's economic analysis? Because we are going to look at the major macro variables, how the variables are determined, no, right? What factors determine the variable, what kind of relationship is there, how these variables are changed over the time, right? So it's a kind of analysis. We need to make an analysis. Right? We are going to look at what are the factors that determine growth. We need to analyze those factors. No? What kind of relationship is there, no? Right? When the technology is affected, no? There are different factors, no? Right? Factors of production, and other factors, no? Right? Maybe the investments, no? Right? Maybe the government expenditure, maybe the trade, no? Right? That affect the growth, right? So we need to find out how these factors affect the growth. We need to have a kind of, we are going to look at the practical aspect. You have to do a research, no? Right? To determine. Right? You need to collect the data and analyze the data and see what kind of relationship is there. Right? So that's a kind of analysis. Now in economics, we use this graphical analysis, statistical analysis, no, right? Trend analysis and in forecasting, growth and so on, right? So even in the forecasting, demand forecast, no, right? Like that, right? So it's a kind of economic analysis. And also we look at these determinants, trends, relationship, what kind of actually we are going to look at all these aspects in this analysis. Right? So the scope partly covered the economic analysis. Right? Under the economic analysis, basically we analyze these macro variables and the averages, aggregates and the averages as we use. Not only that, important part is we cannot ignore policy analysis. Right? So we look at the policies because policies we need in order to control these macro variables, right? In appropriate manner. Right? How we control these variables, how we control the aggregate demand side variable, how we control the investment, right? How we control the government expenditure, export, import, maybe, or the national income, national expenditure, no, right? Those things, no, right? Generally, right? So we need to use the policies. So policies control the macro variable. So in economics, therefore, we need to look at the policy. So how we can policies, what kind of policies we need to develop, right? Designing the policies and implementing such policies. Right? That also analyze the economics, right? Look at economics, basically the macro economics. So that's why we call it as a policy-oriented part in economics. Mostly we look at the policy. In each of the theories that we discussed, classical, right? Keynesian, monetarism, growth theory. So there's a policy implication we are going to look at. So when we are talking about this BSAA, we look at the policies, policy, how the policies can use. Right? So it's control and influence the macro variables, right? So thereby, because our target is to achieve growth. Sadly, right? So, objectives, right? In order to achieve those objectives, we need to control these variables in appropriate manner. So that's why we need fiscal policies, monetary policies, no, trade policies, commercial policies, no, right? So the policy is right, no, right? each of these, fiscal policy basically controls the government expenditure and the revenue, right? Monetary policy controls the monetary factors, money supply, and the interest rate. And the trade, if you take the trade, some kind of trade, right? So that's a policy. Commercial policy is also assuming the trade. Then the rest of the side. Exchange rate policy, currency payment, and the exchange rate, right? So therefore, all these policies they decide to control the macro because they are trying to achieve the macro objectives. Okay. So scope we can divide it into two parts: economic analysis, the economic policies. So economic analysis and the analysis of economic policies. That is the scope of the subject area, right? The subject area of macroeconomics. We are going to look at these two aspects. Right? Is it clear? Right. Any question? Right. Now when we are going to analyze the policies, analysis of the policies basically focus on these. Right? The relation, right? Basically output of the income. We are going to analyze the output, as we mentioned, GDP, right? GDP or GNP, right? And we are going to analyze, and the policies focus on the consumption investment, right? Sometimes we need to encourage consumption, no, right? The government has views, to encourage the consumption, no? Government can use expansion fiscal policy, no, right? Giving some subsidies to the consumers, and so that's kind of encouragement. And the monetary policy, if we take, no, right? So some interest rate, no, right? Durables, kind of relaxation, no, right? So you can give and then so the investment, right? Private investment, right? There's an argument, right? What happened if the government is intervening in the economy? What happens to the private investment? Yes. How the government is usually engaged in economic activities. That happens to the private sector, right? Because if there is a huge commitment from the government side, government has to raise this expenditure in a value. Right? So this expenditure is financed. The government may issue treasury bills, special bonds, no, right? Commercial bonds, no, right? Who are going to finance, subsidize this private sector funds, go to the government sector, right? They don't have avenues to invest in business projects, no, right? Those money comes to the government, right? Then that actually crowd out the private investment, right? The government is invest those things in an effective manner. Is disaster, right? Because there is no proper utilization of the system, right? So that's the type of thing, right? So therefore, we need to analyze that, right? And the exchange rate, trade balance, no, that's the external environment, no, right? We need to control, right? We need to analyze it. How we maintain the stable exchange rate situation, no, right? So there's a 300 that deal, right? There should be stability, no, right? So we know there's down there, right? Side decrease, side is comes from the over 300 level, right? Right. And the money supply, we look at, we analyze the money supply, right? And the interest rate, government budget, right? The policies actually, we look at all these things, right? And analysis also we look at. Generally, those are the, we call it as macro variables and the averages, right? We are going to analysis and the policies focus on these areas, right? Okay. Right. So what are the economic goals? I can move speedily, right? We know, as I mentioned, now we use the macroeconomic policies to control the macro variables in appropriate manner, and thereby we are trying to achieve the macroeconomic objective. Right. So we need to design appropriate policies, control macro variables in such a manner, right? Finally, targeting on achieve macroeconomic objectives. So those are the objectives, no, right? Also. Right? Objectives, right? One is the growth, no? Growth and development. That's the major objective, right? So the growth and development, economic growth and development. No? So if there is a continuous rise in the GDP, that is the economic growth. In real terms, no? Right? Rise in the GDP in real terms, no? Right? Over the years. No? It's a long-term phenomenon, no? Right? There should be a sustainable rise in the GDP, no? Right? Over the years. Right? And that is physical aspect, no? Right? So, and the development also, we need to think about both and the development. That's the other side, the physical, qualitative, quantitative, and the qualitative aspect. So, right? Growth measures the quantitative, physically transferring the output, right? But there should be improvement in the qualitative side, other aspects, social, not only the economic, social, health, right? Other facilities, power, right? Right? So when we achieve in the development, right? It's a one side there should be growth and it should be supported by other improvements, right? Qualitative aspects, right? Stream of distribution, right? Right? All these things, right? And the health factors, right? Housing facilities, right? And the what do you call this other quality of life, being, right? So those actually that measures the growth and development, right? So that's the one objective achieving the growth and development, right? And the stability. So stability means macroeconomic stability, right? So if we are maintaining the stability, there should be a stability in the internal environment and also external environment, right? So we need to maintain the stability, the internal economy as well as external economy. Right? Internal stability means what? Maintaining the internal prices stable. The state prices of goods, right? So if we maintain the price of goods stable, right? And the prices of money, the price of money, that is the interest rate, right? So we maintain the goods prices and the money prices stable, right? So we can achieve the stability. Now, the inflation over the last time for the high level, right? Fluctuations we minimum, right? So basic stability, right? And the price of foreign currency, that is the exchange rate, right? So we need to maintain the stability of the exchange. So that is the coming under the external stability, right? So when we are trying to maintain the prices, stable prices, so that explains we need to achieve the internal equilibrium and also external equilibrium. Right? Stability in the internal environment by maintaining the inflation level, certain level, right? And also the interest rate, right? And the stability in the exchange rate means external environment stability or external equilibrium, right? So we can maintain those stability, then we can achieve the macroeconomic stability, right? Basically, because we need to maintain the stability, that's very important in order to create a conducive environment for the investors, right? Investors need, right, stability, right? Because otherwise, that create uncertainty in the business environment, right? If the prices increase, right? Interest rate fluctuates, right? That because we cannot predict the future, right? There are fluctuations, right? That create uncertainty and the risk, right? This can the uncertainty increase. So that affects the business decisions. Therefore, in order to maintain the favorable environment for the business sector, right? We need to maintain the stability. Right? So that is very, very important, right? And the other objectives means what? Other objectives mean now we need to reduce the power, right? We need to achieve the fair income distribution, right? And we need to maintain the development, the fair and the region, right? Regional development, right? Not only the Western province, in other provinces as well, right? There should be a development, regional development. right? So those are the other objectives, right? And poverty, eradication, right? Reduction in poverty, the income distribution, and regional development, right? Such kind of things, right? So all these things are we identified as macroeconomic objectives, right? So you can think about more, right? Simply explain the growth, right? We can think about how we can achieve the growth, right? So by that explaining the economics, so you know that that's possibilical, right? It is online, right? In full employment, price, price in the PPC, shifting the PPC, that in the growth, that expect the productive capacity, there is a change in the physical output, right? And development is more composite, right? It's not only the growth, should be achieved by maintaining other favorable the factors in favorable manner, right? Especially into qualitative environment, right? And the stability is another objective. Those are the objectives. So in order to achieve these objectives, as our client target, right? So we need to manage the policies in that, okay? So managing the policies, that means basically manage, implement the policy to control the macro variables, right? To achieve this objective, right? Right. Is it clear? Now we know the economic, macroeconomic objectives, right? So you know why these objectives are important, right? In macroeconomics, we are trying to achieve these objectives by managing the macro variables, right? So that's why due to policies as well. Right? Now, if we explain the further, right? Now we know the macroeconomic issues. I ask, what are the macroeconomic issues? Current macroeconomic issues. They are. Yes. What are the macroeconomic issues? How we are having, even though there's some certain inflation is there, no prices are very high, right? Then, price fluctuation is minimal, right? Still in the higher level, right? Level is high. And the growth, income. You have sufficient income. Your income is, are you satisfied with your income? Your salary? Problem. The income. Of the income, right? And the output. Our growth rate is not high, right? Last time we have negative growth, right? That's at the lower level of growth, right? No documents are there, right? Corruption, right? So we have solving problem, food space, right? Because of the corruption. Yes, or is low, right? So those things, basically issue and the balance of payment, right? Budget, right? Right? It's 8%, 8%, 8%, no, right? And the exchange rate problems we have. And rate is depreciated, right? Because from the rate 300, right? And we have the balance of payments problems, right? Likewise, we have the macroeconomic problems, right? We are running with these problems. We solve these problems, right? That is our target, right? One thing is in order to address these problems, so basically these problems are directly or indirectly related with production of production is say of both, right? We need to increase the productive capacity of so with the production. See, there is low production, all these problems create low income, low unemployment, right? Prices start with all those things, right? But to our consumption, right? Yes. And demand and the prices also increase, right? So that explained by the virtuous circle of poverty, right? You know this VCP, poverty, right? So VCP, So with the output, how it is, we can do away to start right? So that actually also explain the relationship between these variables, right? For an example, low income, right? So therefore, if there is a low income, what happens? Our income only actually not sufficient for our consumption. They are not saving, right? No savings, right? Because part of your income you save, right? Right. Part of income you consume, other part you save, right? Take the Y as the income, that explains C plus is right. Part of income consumed, other part save. Right? If you have low income, you cannot save, right? Lower savings. If there's a lower saving, what happens? You are not saving, right? There's lower investments because savings are mobilized for investment, right? We can save more domestically, right? We can invest, no? So our domestic investment is low because our domestic savings are low. We can check the central bank report, what is how much is our domestic savings, right? Our domestic investments also, capital formation also low. That's why we need to rely on foreign savings. That's why we need to attract foreign investments, right? That's why we need foreign aids, foreign donations. That's why we need to borrow external. Right? So lower savings means lower investment. Right? We cannot invest. Right? If there is a lower investment, what happens? Lower capital accumulation, right? Because if you are investing more and more, capital goods increase, right? Capital stock increase, right? That expands the economy, right? So since there's a lower investment, lower capital, right? Accumulation. Capital stock is lower, right? That's why that's a main problem. And if there is a lower capital, lower productivity and lower employment, right? Because they cannot increase the output, right? So there is a productivity, lower employment, and lower employment mean again effectively lower income, lower production. Right? So that is actually this is the circle, right? Kind of circle, right? These things are affecting, right? So we need to drop this, right? So if we can increase the output, right? Production, right? Yeah, solve most of the problem, right? So that's why our problems closely associated with need to think about how can increase the production base. Then units, right? Effective production base, right? Right. So that's why we need to think about increasing the productive capacity as we discussed, right? So if we can increase the productive capacity, we can solve the problem, right? So the growth and development is that's very important concept, right? That we are trying to achieve, right? So there is a supplementary agenda going to you, right? Growth and development, right? Concepts in the explain, right? So physical aspects and the other qualitative aspects development, right? So we need to refer that one, right? I will talk about that one there. Okay. That's an additional note, right? We are not going to talk about, right? So please refer the economic growth and development supplementary. Reading is to be due, right? And the next time you will get more understanding of it, right? So that's a very important macroeconomic objective. You can understand the importance of achieving the economic growth because that's why all these problems created, right? So macroeconomic, right? Right. So in order to increase the growth, there are two ways. One is so that means how we can increase the productive capacity. One is the expansion resources, right? Other one is productivity. We need to enhance the productivity, expand the resources. So those are the two resources. So resource base means we need to convert some usable resources in convertible state, right? And we need to find new resources through the research and development, right? And we need to attract more and more investments, foreign investment, API, portfolio investment, that increase the resource base. Right? When we are making the foreign direct investment, FDI comes as a package. Not only the money, we get the other resources as well. Resources, technology, right? National techniques, right? So, right? So the technology also gets right? Kind of package package. Again, no? So that expands the resource base. That's why we need to rely on foreign investment, right? Foreign direct investment, portfolio investment in order to increase the output. Right? And the other one is the productivity, right? So that is very important, right? We need to use the one technology, right? And so on, right? And we need to train our people, right? Increase productivity, right? Education, right? That's also very important. With education, right? Increase the productivity, right? So that's why you are here, right? I think that's improve the productivity. You are skilled, right? You are become a professional, that increase much capital, right? That increase the output, right? That way, right? So those are the two ways. Process and the productive. So the business cycle explained, how this the major macro variable we take output, right? So this can be related with the any other even with the sales. Sales volume. If you take the overall GDP, world economic output, right? We can see upwards and the downwards. World economic output, right? GDP. Right? So the expansion come to the peak, right? Then the contraction and come to the minimum point, recession, right? And then again expansion, right? That way, if you look at the behavior of the output for the world output, right? You can see these upswings and the downswings, right? Fluctuation. So that explains the business cycle, right? Along this trend line, right? So over the years, the output is fluctuating around this trend line. Explain the business cycle. Yeah? So we see the expansion is a good period, right? Come to the boom, right? Top level, right? And then again we see a kind of contraction, recession, right? Declining down. Right? So associated with that, we see some changes in the economy. Some symptoms also there, right? So that is recession, right? And the expansion is. So that explains the business cycle. One cycle coming from this year to year, right? So one cycle, one business cycle, right? So now we can look at this behavior side, and we can predict the future, right? So how the world output, how this is going to be changed, right? Based on that, we can make some interpretation. Depreparation, right? Base those elements. Right. So the questions, those things are again. So the questions we have, what determine the output, employment, right? Basically, what determine the output, employment, and the prices. Right? The theories that we are going to explain. We look at the output is determined, the employment is determined, how the price is determined, how the interest rate is determined. Right? Those are the questions, right? So we are going to, when we are going to analyze these questions, we need to think about the market. Macroeconomic markets, right? Not the microeconomics, market, right? Now here the market is our product market, output market is there, right? and the money market is a real, and the money market is there, right? And the foreign exchange market. So we have the goods market, right? And the financial market and the foreign exchange market. Right? So we are going to explain this kind of market is there in macroeconomics to explain the overall economy, right? And also we see the markets changes, imbalances, right? All these markets, there are demand and supply forces. So that explains the aggregate demand, aggregate supply, general cost. Right? If we take the goods market, right? So we see the demand. So that explains based on the aggregate demand and the aggregate supply. Money market, in general form, we take the money demand and the money supply. That is the money market. Foreign exchange demand and supply. Right. Imbalances we see now. Since we are talking about macroeconomic equilibrium. In the macroeconomic equilibrium, as we mentioned earlier, right, unlike the microeconomic equilibrium, this talk about the general equilibrium. Is all these market at a particular time come to the stable state. The particular income and the interest rate. We identify the real sector determine income, sector determine interest rate. At a particular interest rate and the income level, all these markets come to the stable state. That's a kind of general equilibrium situation. Right? So we are going to analyze that situation. Right? How the equilibrium, macroeconomic equilibrium, took place. Right? It's such a market, right? So that's a kind of general equilibrium analysis. Right? So we are going to use general equilibrium analysis, right, in the ISLN model, which we are incorporating with both market, real sector and the converted sector. Okay, right? So we can take the exchange rate also, we look at that one, the extended ISLN analysis, open economy ISLN. So that's explained the general. Yeah, right. Okay. So those are the things, right? The questions we have, need to solve the questions, but determine output and the prices, we need the same. So when we are explaining those things, you need to incorporate market as well, right? And the equilibrium as well, right? That's all general equilibrium analysis. Macroeconomic analysis use the aggregate demand, aggregate supply. So that together with the other markets, right? We explain the general equilibrium analysis. Okay, this is we are going to explain the overall economic. Right. Now, what are the policies that we are going to use? Because as we mentioned, policies is very important. Why we need policies? As I mentioned earlier, right? We need to design policies in order to control those variables. In order to manage those variables, right, in appropriate manner, we need to design the policies. Right? That's why we identify macroeconomics as a policy-oriented part. Right? So, what are the policies? Now, monetary, fiscal policies basically the government expenditure and the revenue, right? Budgetary policies, right? Monetary policies, money demand, money supply. So basically, the money supply is the one. Right? Here we are going to control the money stock in the economy and the interest rate. Right? Instruments are the money stock, the interest rate. Trade policy. What are the trade policies? And the trade and the commercial policies go hand in hand, right? These are those policies we use in order to control our interaction with the other nations. Okay. We are dealing with other nations. How we are going to deal with other nations. Right? Basically, based on the trade and the commercial policies. Trade policies are, those are the policies that we know. Can make standards. You control the taxes, right? Import taxes. And some controls, right? For an example, quotas, right? Quotas, right? Rice cake and 70 million, Comes up to, like that. Some quotas is given, government decide, time to time. And the agreements, bilateral, multilateral agreements, to come in under the trade policy. In order to, how we are going to deal with the other nations. In order to get the more benefits to us, right? Normally, we use these trade policies, right? Against the fair trade, right? So if we are going to impose tariff on imported goods, right? That against the free trade, right? So international trade, right? But we are going to get more benefits. Right? So that's why we are going to implement these trade policies. Right? Because in order to control the domestic industry, right? In order to protect our industries, right? Sometimes we impose restrictions on imported goods, right? Quotas. And sometimes if you want to encourage exports, we give the tax rebates, right? Compensation for our exporters, like concession, all these things, right? And other side, we see in order to encourage, in order to get the benefits, sometimes we use strategically, we get into agreement with the other region. So those things come in under the trade policies. And the exchange rate policy, those are the basically what are the exchange rate policies? So we have the now we are going to that explain the exchange rate determination. Right? Sometimes the government control the exchange rate, right? That is called kind of fixed exchange rate system. Right? We are allowing the market forces, demand and supply forces, foreign exchange demand and the supply forces to operate freely. We are going to coordinate exchange rate policy, right? So sometimes we use the both, hybrid, right? There's a government intervention system there, right? The market also determine. That's called managed forces, right? Manage. So like that way, we can use different policies, right? Normally, most of the time, we have to manage forces. Basically, the market determine the exchange rate, but central bank readjust the exchange rate in appropriate manner, right? So we pick the upper and the lower band, right? So that's a kind of managed exchange rate system. So we have fixed exchange rate system, managed, coordinate exchange rate system. In early, before 1990s, 1970s, we had some kind of another exchange rate arrangement. We call it as dual exchange. What is dual exchange? Dual exchange. Basically, under the Ross regime, 1970s, under the Ross economic period, the policy is the dual exchange because there is a higher level, fixed level, and the lower level. Two rates operate. Why there is a two rates? Because one side we need to control the force of function fixed. Non-residential. Therefore, higher interest rate applied for such and the other one, lower interest rate for exports and the essential goods imports and the exports of non-traditional products. Non-traditional. There's a kind of encouragement given by the government to encourage non-traditional exports. Not picking up on other exports non-traditional. Like that, and they figure that price is based on right? And some always. So that right? There are so many things to the and starting asking, but they have conventional expense, right? Even the powers, right? Right. So you want to encourage such things, conventional expense, government declare over exchange rate assumptions. So that is a dual exchange rate system. It's a kind of control system. That's also coming under the trade policy, exchange rate policy, right? Now the commercial policies, those are the, in general, compared with the trade policy, these commercial policies are more general, right? So what is the policy that we are dealing with the rest of the countries? That actually gives some kind of guideline to implement the trade policies as well. Right? For an example, now the commercial policy, we can identify two policies. One is ISI and the other one is the export promotion. Right? Export promotion, industrialization, and import substitution, industrialization. That is our industrialization policy. Right? Right? So that's a commercial policy. Right? So based on this industrialization policy, sometimes government has to use appropriate trade policies as well. Right? Because if the government is to encourage domestic industries, right? Therefore, certain goods imports control, right? Bans imports, right? Now, ISI, you know ISI, import substitution, industrialization, right? Those also come in under so the commercial policy, right? This can identify those are two general policies, right? General, right? General policies, more general, right? That actually explains our industrialization policy. So one is the ISI, import substitution industrialization. Other one is export promotion, right? Import substitution industrialization, export promotion. Import substitution industrialization and an additional karmika, right? You know that in 19 under the British control in 19 we used this one 1970 70 to 71 to 77 ISI, right? For substitution industrialization. We actually, in order to increase the domestic, in order to encourage the domestic industrialization, most of the imports we ban, right? And government make commitments to some kind of extra commitments to establish those industries. Local, right? Import substitution industrialization. And the other one is export promotion. After 1977, basically we adapted, right? Under the open economic policy, economic liberalization policy. Export promotion, right? Export promotion. Export promotion, industrialization, strategy. Now we have the two strategies, right? One is import substitution, industrialization strategy. Export promotion, industrialization, right? Now, we know that here the basic purpose is, what is the purpose of import substitution industrialization? Basically, protect foreign exchange. Protect or save foreign exchange, right? Protect or save foreign exchange, right? And we use the ours with the without orientation of the so we establish our domestic industries, substitutions, right? Say most of the they don't know these institutions privatized, right? After the next step is right? Privatizing, right? So that's why we have so much of arguments coming, right? So, right, this is the basic protect or save foreign aid. We are not going to import goods, we are locally produced. Right? We are going to solve our problem by And here the basic thing is export promotion means earn foreign exchange, right? Earn forex. Earn forex. Forex means foreign exchange, right? We are going to earn foreign exchange by exporting more and more goods, right? We are producing not for our market, for the external market. That's right. Export processing for export processing zones, industrial parks, right? Created, right? And attract foreign investment, establish UI companies, right? Earlier we had the GCSC, Greater Colombo Economic Commission, and after 1992, it was renamed as UI, Board of Investment, and giving export promotion from the old time began as whole alignment as all these foreign direct investments and bank foreign investments. Earlier it was confined to created some areas, but they got entire island declared. But track foreign is the establishment of BOI, Board of Investment, right? So that's basically we are producing not for ours, for the external exporting, right? Or earn foreign exchange, right? So that is the commercial policy, right? We have the commercial policy, right? Okay, right? So many things are there, right? Anyway, right? So fine. Now the fiscal policy, if you look at, right, those are basically government expenditure and the revenue, right? In the national level, what are they? Right now you have the that under the fiscal policy, government expenditure and the revenue. So expenditure, you must know, right? When you have a understanding about this, our expenditure, right? Government expenditure. It's very important, right? So basically, if you look at the economic classification and the functional classification, two classifications are there, right? So you can refer the central bank calculate, right? So we can see, right? Now, according to the economic classification, basically the government expenditure made on the salaries, right? And the government expenditure on goods and services, and the interest payments, transfer payments, subsidies, right? Representative assess, right? And other the low income families giving some relief, subsidies given, right? Pensioners, right? And the people, right? Like that. So those are the main expenditure. If you look at now you have the according to 2021, right? So our total expenditure is this much. Out of this, we spend salaries this much. You can calculate how much is the percentage. Around 24%. Then calculate, you can see 1/4 from our expenditure goes to salaries. And more than that goes to interest payment for the debt, right? So you can see, you can calculate the percentage. We can get the recent figures as well, right? By referring the central bank and see how our expenditure from as a percentage of GDP you can calculate, right? And get an idea, right? How much we allocate for the salaries, how much we allocate for government consumption, maintain those institutions, how much we allocate for interest payment, right? Repayment of debts as interest on the capital, interest payments, and the transfer subsidy, right? So this is total, right? You can calculate as a percentage of total expenditure and as a percentage of GDP as well. From our income, how much? So you can understand the serious situation. If you look at the different years, right? You can see, right? Kind of burden is there. Here, 85, right? If you take from the total expense, how much we allocate for the interest payments? Here. %38, right? Around 40%, right? Allocated for the 2001, right? For the interest payments from the expense. From our income, you can calculate as a percentage of GDP how much we allocate, right? So that's the structure you can have ideas. Expenditure, right? How we are going to allocate this thing, right? And other side explain the capital expenditure, this acquisition of assets, real assets, capital transfers, and so on. Right? And also, if you look at the revenue, right? Our revenue, if you look at the revenue, right? Basically, our revenue comes from the tax revenue and the non-tax. So we can see, right? Tax revenue comprises direct tax, indirect tax, right? So direct tax, the income tax, indirect tax, and tax, right? Now, from the total revenue, right? You can see mainly it's coming from the now direct tax this much, indirect tax. So main source is the indirect tax. So as a percentage of total tax revenue, right? You can see 89% coming from the. Sorry, this is the 23% coming from the indirect, direct tax 76, right? Like that, right? So you can mainly our tax coming from the, you can look at the direct tax is basically the income tax and other taxes, right? So there is only 23%. Earlier it was lower, right? That's slightly increased. So this tax is structuring, right? So we need to increase the tax base and so on, right? Increase the track, to increase this share, right? And from the total tax revenue, right? Tax revenue is 89%, non-tax revenue is 10%. Basically, our tax can talk about tax and the non-tax revenue, right? Yeah, right. This refer the central bank annual report, right? In order to see those things, right? So those are the basically policies we look at, right? So policies also very. It passed. Passed. Is it passed? You need to refer some alineates as in that. Right. Okay, right. Now we can look at the other thing is this. So we have the shops. Shops. Are the other shops? That's the non-shops, right? Colombo also have shops, right? Thanks. Okay. Thanks. Okay. So those are the traits, right? And the policy is also there. If you look at these two policies and the shops, right? Policies also affect to the market, right? And macro variables and macro objectives as well, right? These policies we can take to expansionary policies, contraction, right? Policies we are analyzing type of expansionary policies, contraction. So what are the expansionary policies? We are raising the government expenditure. No? That is expansionary policy, right? Expansion. Raise the government expenditure. Right? Expansionary fiscal policy. Right? There can be contraction in fiscal policy. If we raise the taxes, that actually contracts because higher taxes discourage also more income. If we raise the expenditure, that increase the output. Right? Expansion, right? Higher taxes, contraction, fiscal policy. Likewise, fiscal policy, we have the expansion and contraction. Raising the taxes is contraction and fiscal policy. Raising the expenditure is expansion and fiscal policy. We take the monetary policy also expansion and the contraction. Sometimes central bank use tight monetary policy and contraction. What are the contraction and monetary policies? What are the expansion and monetary policies? If the central bank wants to increase the liquidity in the market, then use expansion to fund the funds. Increase the money supply. Expansion. If the central bank limit the money supply in order to control the liquidity in the market, that is contraction in money supply. Likewise, we see expansion and the contraction. Now we can think central bank monetary policy tools. There are tools, right? What are the tools central bank use? What is called open market operations, right? Bank rate and the what is the other one? Reserve requirement. Central bank was those tools basically, and some other tools also there are solutions from that likewise. So in order to control the liquidity, open market buying and selling, especially the central bank buys it, money. Buying means central bank purchase, right? Money goes to the market, right? That is expand. The central bank sell special bills, special bonds, the market. Commercial banks and other dealers, they purchase, right? Then this money goes to market to central bank. Liquidity goes down. It's kind of liquidity control mechanism, right? The central bank use open market. Statutory reserve requirement means SRR. Central bank I have to die beside the SRR. With the view to controlling liquidity that goes additional instrument, right? SRR means each commercial bank has to maintain a reserve with the central bank, right? Statutory reserve, right? It's kind of kind of marriage, right? System. Thanks. The statutory system requirement, if the central bank increase, what happens? The central bank has to give more money on behalf of the central money. That means their lending capacities increase sometimes. Right? Out of the 100, let's say 20% has to be retained. 80% can be lent, right? From the deposit. Therefore, it limits the lending capacity of the commercial bank. So, lending capacity control means money creation control, right? Then control the lending. Likewise, central bank use these instruments, right? And the bank rate also central bank has a rate of last resort. Awesome, right? Awesome, then last resort. Okay, right? So those are the different instruments and the banks. So coming under that, right? So we can identify these policies, expansion or contractionary. Those policies in the central bank for the government of the government treasury policies. That affect the market and the macro areas. And the shocks. What are the shocks? Those are there are positive and the negative impacts are there. Right? The shocks also affect the market and the macro variables. Economic objectives. We have the internal shocks and the external shocks, right? Internal shocks, what are the internal shocks? Then we have any why no right? Right? Internal shock, right? What happened to our any? That's a shock. And the earthquakes, tsunami is external, right? Some kind of iron, right? So different shocks are there, right? And the drought situation, right? Those are the internal shocks, negative there. And the external shocks may be tsunami or financial crisis, no, right? Sometimes it may affect positively or negatively. Tsunami is a positive effect. Bunch of country, no, right? You got to do that. Ashirwad is Srilanka. It's Srilanka, right? Positive also there, negative also, right? External shocks. So we can see positive, negative impacts, right? So those shocks also affect the market and the macroeconomic. Those are the threats coming from the internal environment and coming from the external environment, right? So like the policies, shocks also have similar impact, right? We need to take some action, right? Yes. Six. Okay, so do we need a break? Okay. Take a break and any questions? Any questions? I asked you to further think and talk from the previous matters. What topic?
Hello. Hello, sir. Can you hear me?
Yes, we can hear you.
Yeah, sir. Can you please explain money income and money supply and demand with the example? One example that please.
Money supply.
Money supply and money demand.
Yes, now we need to talk about that. Okay, money supply and the money demand, right? So those are the, we identified certain variables, right? Which represent the real sector and the monetary sector. So the monetary sector identified the money demand and the money supply, right?
Mm.
So money demand and money supply, right? Those are the
Yes.
variables that we identified in the monetary sector. The money demand is what is money demand? Yes. So that means how much people are willing to give with their hand, right? So that is the demand for money for spendable purpose.
Mm-hmm.
Spendable purpose. So that means how much we are keeping in our pockets, right? For day-to-day expenses. For the that is demand for money, people are willing to keep with their hand, no, right? For different expenses, right? The money demand actually, according to the money demand, according to the explanations, why we keep money in our hand. So that explains the motives, right? Motives. So we can identify the three motives. One is called transaction motive. Okay, transaction purpose. Other one is precautionary. Pautionary, right? Precautionary. Other one is called speculative. So the people demand money for different purpose. People demand money to achieve. Now, why people keep money with their hand? For transaction purpose, for precautionary purpose, for speculative purpose, right? Right. What is the problem? Yeah, any problem? Right. So now we are talking about these motives for keeping money. Why people demand money, right? Transaction motive means for day-to-day expenses. Right? Now you are need money, right? You are coming from home, right? When you are coming from home here, right? You need to use taxi maybe, right? The right? Last one. for the task, right? You need to keep your money, right? So then you need to consume, right? Breakfast, lunch, right? You need to keep your money with your pocket, right? For day-to-day expenses and your education expenses, right? Yeah, pay fees, something, no, right? So that's all these things, right? So the money demand under the transaction. So that actually MDT, money demand under the transaction. So you keep more money if you have, okay? If you have very lower level, right? You use the public transport, right? If you have some sort of income avenues and you are rich enough, right? That you use the taxi and company, right? Likewise, no? Right? So money demand under the transaction for purpose depends on your income, right? You may have different choices. That depends on your income. When you are income increase, money demand under the transaction purpose also increase. You consume more, right? To keep more money, right? For such expenditure, right? It's positively related. Money demand under transaction purpose, positively related to the income, right? What is precautionary? Money demand under precaution. Precautionary means sometimes when we are coming, sometimes we have unexpected, right? Expenditure we have in answer, right? Sometimes we may have some repairs. No? Our cars, we are using car, right? Sometimes we need to buy again, right? Some kind of harness, right? Hardware, right? Engineer some kind of some kind of repair, right? And you need to go undergo with some medical treatment, some by surgeons, unexpected use. We need to keep money, right? So that also depends on income, function of income. Why? It's also positive related, right? When your income level increase, money demand under the precautionary model also increase. You give more money because your income level increase, you are going to not the government hospital, private hospital. Your income level increase. The lower level income, you go to the government hospital, right? So you need less money, right? But if you are going for when you are income level increase, you go to the private hospital and get the treatment there, right? So the money demand under the precautionary motive depends on income, that's also positive related, right? And the speculative motive means portfolio motive. Portfolio motive. Portfolio motive means business purpose, right? You keep money. Business motive. To earn profits, right? Earnings. For its investment purpose, right? So why you keep money, right? So money demand under the speculative motive. Speculation, right? Portfolio, you maintain different portfolios, right? Different investments. With the change in the prices, right? You make a different decision, right? Selling the shares, with the strategy, you take decision, right? Sell or buy such instruments, right? And mechanic earning, right? So that is the speculative motive. Money demand under the speculative motive, that also depends on income, and also it depends on interest rate, right? You need money, right? That depends on income, right? You can do more speculation when your income increase, right? More earnings, right? You invest more, right? And also it depends on interest rate in the market, right? Because if the interest rate changes, right, its portfolio choices may change prices. Right? Now, earlier we had a higher interest rate, right? Share market goes down, right? Now we have lower interest rate, share markets up, right? That explain different factors. One factor is the interest rate, the expectations, the stability, and this agreement sense. management and so on, right? One factor is the interest rate, right? Since we have the lower interest rate, now we see the share market moving, right? But share prices, right? Increasing, right? So it's positively related with the income and negatively related with the interest rate, right? Money market, sorry, speculative model, right? Because the price of bonds, bond prices, this is the one, right? Depends on the face value divided by the interest rate, right? So when the interest rate increases, bond prices decrease, right? So there's a negative decrease, right? Now these are the three motives, right? So why people demand money? Money demand. That's the one force, right? We identified in the financial sector. Transaction. The people demand money for the three motives, right? Transaction motive, speculation motive, speculative motive. Right? So those actually depends on the income and the interest rate. Right? So if you draw the lines, if upward sloping money demand and the transaction and precaution, interest rate is downward sloping, right? There's a negative relationship, right? So that is the money demand. Money supply is the other side, right? So that is actually determined by the central bank, BSAA, Sri Lanka, under its monetary policy, right? Monetary policy, right? So central bank can decide the appropriate monetary policy depending on the situation, right? Liquidity in the market, and basically the money supply, money supply, yes, okay? So that comes under the monetary policy, right? Okay? So now there can be, as we discussed, expansion in monetary policy, contraction in monetary policy. That control the money supply. Money supply means total money stock in the economy. Right? Total money stock, right? Money supply is the total money stock in the economy. How we control the money stock? In other words, that is the liquidity, right? Liquidity in the market, right? How we identify this money stock? Using the monetary aggregates, right? So how we measure this monetary stock in the economy? Central bank use monetary aggregates. So what are the monetary aggregates? Yes. Monetary aggregates, M1, M2, M2, M4, narrow money supply, broad money supply, concentrated money supply, broader money supply, right? So those are the monetary aggregates, right? So the monetary aggregates, you can refer the central bank annual reports, right? M1, narrow money supply, comprised with the currency and the demand deposits, and the broad money supply, M2, comprised with currency, demand deposit, and the time and saving deposits of the commercial bank, and the M2B, consolidated money supply, M2B. So we take into account other commercial bank accounts, right? So the foreign currency banking units and so on, right? And the M4, broader money, right? Retail finance companies, right? License specialized banks, those deposits as well, right? And they, right? So those are the monetary aggregates, right? So we use to get an idea about the total money stock in the central bank, measure those narrow money, broad money, and so on, right? So they get an idea, right? Based on that, central bank decide, identify, estimate the money stock in the economy, and in order to control the money stock into central bank use monetary policy, right? Either contractionary monetary policy or expansionary monetary policy, right? Right? So that is the money demand and the money supply. Okay. Okay. I think you get an idea, no? Is it clear?
Yeah, yes, sir, it's clear. For the money supply, may I know, as an example, in money supply, it's like whether it's like this, because as I understood, in money supply, it is that like the central bank is printing extra notes for the economy?
Yeah, that's the one way. Central bank can use different strategies, no? So the money supply affected now that is the quality very control system, right? So one thing is central bank print the money, right?
Mm-hmm.
So that also affected the money supply. Right? Now central bank these days they are not using that printing money under the agreement with IMF. They are not using that, right? So money printing is highly inflation, and that is called synergy, right? So that is one way of now central bank just print the money. That's the monetary authority. Central bank has given power, right? To control the liquidity. If there is a liquidity shortages in the money, central bank can print the money, right? But that should be done in very careful manner, or since it is highly inflationary. That's the one. That is all. Central bank has all authority to issue the currency. So that is the money printing.
Okay, so that is one of the way to release it's like the supply the money to the economy, right?
Yeah. Another thing is central bank can even central bank issue the other ways treasury bills and so on is under the open market operations. So that's also kind of liquidity control mechanism. Instead of printing money, central bank use now or nowadays central bank highly relied on this market mechanism, market forces, open market. So buying and selling treasury bills, right? Rather than printing. And last time we observed that, right? It's change in the bank rate and the open market operations. So the main instruments central bank use rather than printing money, right? So that is expansion for central bank take the money. That's basically there's a liquidity problems in the market. So that's the one way. But keeping that one constant, really constant stop, right? Central bank can control the credit creations, right? Credit, that is one way of controlling the liquidity in the market using this central bank instruments and open market operations, SARA, and trade policy, and so on, right? And the most important thing is, right, this is, we talk about this money demand. We take the money demand curve downward sloping, right? And the money supply we draw like this because it's exogenous variable, right? So this is the money market that we are talking about because we identified in macroeconomics real sector and the monetary sectors. Monetary sector forces according to this explanation, money demand and the money supply. Money demand curve is downward sloping curve we draw, right? Money supply curve we draw this way because it's the policy variable, right? It's determined by the central bank. Right? So we cannot change, right? So we take it as given. So this determines the interest rate. So how the interest rate determined, that is determined in the money market based on the money demand and the money supply. This is the real money balance, money stock. So that is the real money stock. MOP means real money stock. Right? So now central bank can change this one, right? But according to our one, this is exogenous variable money supply variable. Right? So that's why it's become concern. Vertical, right? Okay, so that's about right.
Okay, sir. Thank you, sir.
We can think more, right? We will discuss now this money demand and money supply, money market, this explanation, right? The future discussions that we are talking about this model. So we take into account that. That's why we need to identify the money demand and the supply as variables which represent the financial segments. So we can take your break, right? So any questions do we have? Okay, right. So that actually that question take out with the other thing. Okay, that thing is right. So right. We just try to read. Right? Okay. Anyway, that's really important, right? Thank you for asking question. Anytime you can raise questions that will actually redirect our discussion into different aspects, right? That will you will be able to get more information, more understand. You ask question. You are asking question that will not elaborate. Some insight, like some other facts come into the disclosure, right? If you ask a question, answer it. Otherwise, I will go. So that's why I asked you. Any clarification, any explanation, if you have, you can raise those questions. So, you can take your break. Right? It's the date for the exam. It's February 16th or second week. He actually chooses the what is postpone. It's another 1 day. Then another call them yes. Speaking at network. Well, yeah, we done wrong. I said, secret. I think 9. No, I think we have 9. Because the date academic set. Right. Second, February 2nd. Next week. Okay, I will upload the element, right? I forgot the date, second or ninth. Because we actually, most sessions we, able to complete two sessions, the one is post and other one. So shall we start, right? Or, I have so the second February, right? Last 2 days. Okay, so we talk about the oxide vessels, right? What is the okay. So we are coming to the national income. I think now we would have also have understanding about the national income. We are going to look at all these concepts. I just to have a national income, and then we are moving to the national income integration model, right? Is AC model, right? Now, what is the national income? Simply, what is the national income? So it is the finally now we are going to measure the This is the national income means we are going to measure the overall performance of the economy. So that measures the end result of the economy. National income is the end result, final result, which measures the overall performance of the economy. Right? So that is the total money value, of goods and service produced in the country. Right? So now how we can measure the national income? As you know, there are two approaches, right? One is called how we measure this overall performance in result. One is the final product approach, and the other one is value added. Right? We take the value addition, or we take the final production. Right? Otherwise, there will be a problem in measuring national income. So sometimes they overestimate, right? Right? We take the market value of something, right? So sometimes maybe a double counting error, right? Avoid the double counting error. So we need to use either value added approach or the final production, right? So that is the double counting problem, right? So if we consider the market value or value addition both, right? Because if we have the market value, actually you will see that actually there's a value addition also, right? When it comes to the market, right? So in order to avoid these things, actually we need to use these two approaches, right? One of these approaches, right? To avoid the double counting error, right? So if there is double counting error, that will overestimate the national income, right? So and the other thing is, right, now if we take the intermediate products, right? That's there will be a problem, right? Intermediate, right? So that means we need to we are not included the intermediate products, right? We avoid that one also, right? And the other one, you know that some durable goods, right? In case of durable goods, how we take into account the national income accounts, right? So actually, so we are, even though actually durable goods, right? But at one time and you consumer long time, right? We take the refrigerator or something, these fans and so on, right? So we take normally they are like Chinese, then money, right? We take a computer, normally it's 5 years, right? And it is outdated even one side, right? They are coming. So that we are going to include at the time of transaction take place, normally. One time, we take it out at the transaction, the rate of the transaction. Right, and in case of government, it's services, right? Normally, now if we take the education, health, right, government services, we are not taking into account at their market price. We are going to take into account at their cost, so the historical cost, in the national income, right? So those are the basic things, right? And sometimes you know that we need to, you cannot estimate the real value of that one, right? Sometimes people, this national income estimate this, right? If you cannot have, for example, there's all the effective transactions, right? All the effective transactions, right? All the effective transactions we take into account, right? National income estimation, right? Effective transactions, now if you take the kind of samadhan or something, right? So we take the construction of road, getting the support from the vehicle with drainage, right? That's effective, right? But you cannot take the values, right? Sometimes we can give a significant variation. In our opening, estimate the value, right? And we try to the imputation. Sometimes we have to use that one. So there are arguments also, right? Some effective transactions, sometimes we are not taking into account, we take outside activities and so on, right? So there are such arguments of one side, we argue, if these are effective, right? There is no, there is create support from the server to something we added internationally, right? Housewife, wife, ladies, they are doing so much of activities in the house, right? They are not taking work from home, right? So those things there are, right? You need to one side be effective transactions, all these things. Only we are going to take equal from these things, right? Right. Now, if you take the value added, right? Now, with this simple example, right? Now we know that normally the production plays through a process, no? There is production process. Now we know that if we take the right final productive cycle, so, right? If you take the wheat first, right? At the first stage, right? We take the wheat production, right? Let's say something, some values, right? 300 million, right? And that will be then converted into wheat flour, right? And then we'll produce the bread and sell it in the market, right? So now if wheat production 300 million, right? When it comes to the wheat flour, so there is a valuation and improvement, right? Value increase and up to 500 million. And bread, you know that it will increase to 800 million, right? And when it comes to the market, right? There is another, we take the sandwich and something, right? 1,000 million, right? So now, how we now use this two approaches, right? If you take the total value, 300, 500, 800, 1,000, how much is that? 1,800, 2,000, 2,600, right? If we take that value, adding this value, right? This is 2,600 million, right? Can imagine any value, right? We just did value, right? So if we take that value, is it realistic? So if we add the is the value of production, wheat flour, say bread, and the sale of bread, right? Selling price and so on. All these things, if we add, will equivalents to 1,000, 1,800, 2,001, 2,600 million, right? If you take that value as a national income value, right? So what is the problem there? Yeah, there is a double counting, right? Double counting. So that actually, if we add that 2,600 into the national income accounts, there will be a overestimating of the national income. So that is normally we have. Therefore, we have to use value addition, right? Value addition means at each stage you can calculate the value addition, right? So that's very important. At the very first stage, we take the same value, that is the wheat production 300, right? When it comes to the second stage, wheat flour, value addition is 200, right? And the third stage value addition is 300, right? And the final stage value addition is 200, right? So we add the values, right? So how much is the total value? Here 300, here second stage, when it comes to the 300 into 500, 200, and 300, 200. How much is the value addition? Total value addition is 1,000, right? So here the 1,000, right? So that is the value addition. We can take that value addition, right? And we can take into account 1,000 as a total value addition to the national income, right? Or we can take the final product, 1,000, right? So that is the 1,000 is the final product, right? So that value we can add to the national income, right? So if we take the 2,600 total value of each of these processes, no, right? 2,600, that is of estimation of the national income, right? So that's a simple example, right? So normally we take the value addition of this final product, right? We take into account in adding the national income, right? Okay, so value added method, right? We take the now in our economy, we know that if you look at the structure of the economy, contribution coming from the agriculture, manufacturing, service, right? So in the value addition, that is the GDP, right? Gross domestic product. Value addition from the agriculture, value addition from the industry, value addition from the service sector, right? We take the value addition from each of the sector, no? And we add it together, that will form the GDP, no? Right? Gross domestic product, right? And that is the output method, no? Right? We take the, now there are three methods of calculating national income, no? One is called output method, income method, expenditure method, no? Right? According to national income accounting approach, right? Now value addition from the agriculture, industry, sorry, some contributions coming from the that will add to the national income from the GDP. If we take the income method, right, we take the rent income, wages, interest, profit, no, right? So that is the total contribution coming from those sources, right? So that is the value addition, rental income, wages, interest rate, profits, right? So this is the gross profit, no, right? Gross profits, right? So that actually not the net profits, right? Next net profits, right? Here this is the gross profit, right? And this is the gross value, right? We take into account, right? That include this depreciation and the capital formation there. All these things are there in the gross nature, right? So that is the according to the income method, right? We take into account but now we are producing the goods, right? How much we pay to the this landlords, no? How much we pay to the agents, interest and profit. So that is the income method, right? And in the expenditure method, what we do? We take the total expenditure, no? Right? Producing goods, no? Right? Or acquiring products, no? Right? So that is the expenditure method. We add the total expenditure, consumption expenditure, government expenditure, and the private expenditure on investments, no? Right? Investment expenditure and so on, right? So we have the three methods. We know that output method, right? We take output method, that means the value addition. Now we estimate the value of each and every output produced, no? Right? Then we can get together. So these things together that form the national income according to output method. Income method means income paid to the factors of production. Expenditure means based on the expenditure item, right? So that those are the national income accounting approach. Then what is the social accounting? Then social accounting. We charted, you know that social accounting? What is social accounting? So one thing is under the social accounting, we are national income accounting approach also under one method of social accounting, no? Right? How we estimate the total output for the national income, no? Right? Based on output income expenditure method, no? Right? So that is also coming under the social account. Apart from that, there are other social accounting approach, no? Right? What are those approaches? Yes. So one social accounting means national income accounting, right? That is one, no, right? Know that there are three methods, no? There are three methods: input, output, explain. Right. Other one is input output approach. Input output approach. Input and output approach, the total inputs and the output we take into account. Right. What we incorporate into production process. No? By looking at those things, we can generate, we can see the contribution or the total that we, by looking at analyzing the inputs and the output, we can estimate the total contributions. Right? And the other one is fund flow. What do you use that one? No, right? Fund flow statements. Funds flow approach, funds inflows and the outflows, no, right? Fund flow approach, no, right? Funds inflows and the fund outflows, no, right? You can estimate the contributions, no, in the overall economy, no, right? For the inflows and the outflows, right? Take it into account, right? And the other one is balance sheet approach. Balance sheet approach, no, right? Balance sheet approach. Under the balance sheet approach, you know about the balance sheet, no? We look at the assets and the liabilities. So we come back, no, right? Okay. All these things coming under the social accounting, no, right? Right. So here we are looking at the national income approach, national accounting approach, right? National accounting approach. That is social accounting, right? Okay. Right. Moving to the next. Okay, right. Now the gross domestic product, right? Now gross value, right? So that is like something that we got in production, no, right? Produced within the boundary, no, right? Within the geographical area, no, right? We can play gross domestic product. And here we consider the location, no, right? Regardless of the ownership, no, GDP, right? Gross domestic product, right? Here, Sri Lanka, no, geography, right? Whether Sri Lanka, no, not Sri Lanka, foreigners, no? They produce here. All the goods and services produced within the geographical area, we take into account GDP, no, right? So here they are actually consider the location domestically within the geographical area, not the ownership. Either locals or foreigners. No? They can, right? No problem. Nobody's, no, right? So that is the GDP, right? Okay. Gross domestic product. So that is the total value of production in a particular year within the geographical area, no? Regardless of the ownership, right? And that is we calculate GDP from the contribution coming from the agriculture, industry, services, no, right? According to the output, no, right? And gross domestic income means total factor income received by the household, no, right? Right? For the factor owners, no, right? In the production process, how much they receive, no, right? As a factor income. So that is the rent, wages, interest, profit, no? Gross profits here, right? So we look at the gross domestic income. Gross domestic income, right? So the post total factor earnings, right? And the gross domestic expenditure means consumption expenditure, total consumption expenditure comprising private consumption and the government consumption, right? And the gross domestic capital formation, that is the investment. Gross domestic capital formation means investment. So that is actually that form the gross domestic expenditure. So those are the costs. And what is the difference between the GDP and the GNP? Now GDP, you know that, right? Within the geographical area, total output produced per year. right? Like the Sri Lanka, no, foreigners. When it comes to the GNP, right, we take our people, if they are producing in the rest of the countries, no, right, doing some activities there, that we need to take into account, right? If we have investment in the London, no, right, the dividends received, no, right, the profits received, we take into account. Our people invest in other, we need to take into account nationals. And others also, other foreigners also do something here, no? Right? They make investments, they need to pay dividends, no? Interest for their. You need to deduct that part, right? Because nationals only we take. Sri Lanka. That is GNP, gross national product. Right? So the GDP is the total output produced in the geographical area, right? And GNP arises because some of the output produced within the country is made by the factors owned by the people and also our factor owners in the rest of the country. We take into account those things. So that is called net factor income from abroad we calculate. Factor income received, factor income payments. Right? Factor income received means our people doing activities in the other countries. Factor income received, dividend received, income received, interest received. We add it. And we deduct from that. Foreigners do something here, we have to pay them, right? We have to deduct them. And net, we take into account that we net factor income from output, right? Factor income received and the factor income payment. We take the net value and add it to the GDP, we can calculate gross national product, right? If the factor income payments are higher than the factor income received, right? Net factor income from output is negative, right? Then GNP is less than GDP, right? Right? Since most of the things done by the foreigners here, right? We have to pay for their dividends. You see, there's a GDP and the GNP is difference normally. GNP is less than GDP since the net factor income is negative. Right. So we calculate these things, right, by adding all these billion of goods and service produced, right, based on the output methods, right, and the counts value production in all market products, businesses, consumers, works, and the business, right. So GDP output of all the production, agriculture, we take into account, and we take the exported goods and service, right, and foreign firms output within the country. That also we take on GDP no matter. Right? But we are excluding imported imports and local firms output outside the country. So those things are actually NER and GDP. Okay. Now here we have given a simple example. Now here we are actually GDP concerned, right? There are two terms: GDP at market price, GDP at constant price. Constant price means real GDP. Normally we need to if we take the market value every year it goes up, right? Because of the price increase, right? Therefore, once you value the GDP at market price, it increases. Therefore, it is not good for measuring the GDP growth rate. Right? So we have to take into account the real output and their growth. When we are measuring the output growth, economic growth, right? So therefore, we need to take the real GDP, right? Real gross domestic product or GDP at constant prices. Right? So value of output measured at constant prices, that is the real GDP. Right? We take a particular year as the base year, right? And we calculate the GDP based on that. Right? Today's output we value based on the base year prices. Right? So base year we take it as a constant. Right? Therefore, we actually remove the price differentials. Price changes we remove. We are going to use the real terms here constant, right? It's the BSAA price. So that is the GDP at real constant prices, right? Nominal GDP means market price, right? As I mentioned, GDP at market price, right? So we have different concepts, right? In market prices and constant prices, right? So now you have given the, for an example, hypothetical. This is you can hear different years, right? You can see GDP at current price, right? So that means the according to the prevailing market prices, right? Current price means the value of according to the prevailing prices in the market, right? So we have 1,000, 1,200, 1,500, like that. Okay. You can see normally it's increasing year to year because prices increasing, right? And if you how you take the constant GDP, right? So we can take like the base year prices. Based on the base year prices, you can value the goods, right? Now, for an example, okay, I will take, right? Let's suppose the base constant GDP, right? Year one, right? Year GDP at year one constant price, right? Year one prices we take it as a base year, right? Normally base year we denoted as 100, right? Base year got becoming 100. Then if you evaluate the things, right? Let's say now GDP at constant prices 1,000, 1,100, 1,250, 1,300, right? 1,600. That is the GDP at constant prices. Okay. Based on the base year price. Right. Now we can calculate important concept there, GDP deflated. So that is actually called implicit price index. Right? Normally, in order to measure the prices, right? So that's very good, right? We measure the inflation, right? We use this indicator, right? GDP deflated. We call it as implicit price index. How we get the calculate the GDP deflated? GDP at current price divided by the GDP at constant price into 100. That provides index, right? So nominal GDP divided by the real GDP into 100. So that is called GDP deflated. Implicit price index. Right? Now, if you calculate the GDP deflated here, so nominal GDP or GDP at current price divided by the real GDP or GDP at constant price. 1,000 divided by 1,000 into 100 means 100. So then if you calculate these things, you can have these index figures, no? Right? 109, 120, 100. So that is, you see the index going up, right? So that's the inflation, right? Can measure the inflation as well. Right? So the GDP deflator is the one that we can use, right? Because we take all the goods and services produced in the country, right? So the GDP, right? It's a average value, right? It's indicate the average value of the goods and services price index. Include all the goods produced in the country. That's a good indicator to measure the inflation, right? Now we have the other indicators, proxy index, no? Consumer price index, wholesale price index. There is a sample, no, we take, right? But here, since it includes all the goods and services produced in the country, no? Under the GDP, we take into account GDP. So this is a good indicator to measure the inflation, right? So the GDP deflator, or we call it as implicit price index. Implicit pricing. Now here we, if you take the, now you know this constant price, right? Now if you multiply the, now you can rearrange this one, no, this equation, right? If you want to take the constant price, right? You can rearrange this one, right? So with the cross multiplications, right? You can find the other one also, right? Now, now suppose now Now let's say we are producing two products, right? A and B, right? The two products are A and B, right? So we assume we produce two products, right? Prices of the two products are PA and the PB, right? Price of the product A is PA, price of the product B is B, right? Now, what is the output? We can measure the output particular year, right? So let's take the base year. Base year is 2020, right? Base year is 2020, right? Now we are calculating output of 2024, right? We have two products, right? Output of the 2024, how we calculate? PA into QA, right? Total production of the product A into multiplied by total production of product B, right? Then the PB, QB, no, right? So that is the total output, no, right? GDP, right? This is assume two products, right? Okay, right now if you take the output of 2023, so this is the year, right? We can take now we take this is let's say this is the nominal price, market price, according to the market price. We take the QA 2024 output produced in the 2024, right? Price 2024, output 2024, right? According to the prevailing price. We take this is the GDP at market price. So GDP at prevailing prices, market price or the current price. Right? 2023 output, how we calculate? PA 2023 QA 2023, like that, you know, right? PB 2023 QB 2023, right? Based on those prices, market prevailing price, market price. And now let's say we are going to measure the output for the GDP output. Let's say GDP, right? Because we have two products at constant prices. At constant prices. How we calculate? At constant prices, how we calculate? So that is the real GDP. We call it as real GDP, right? Constant GDP means GDP at constant prices. That is the real GDP. How we calculate? Real now we have to take the base year price, no? Right? We take the base year is 2020, right? And the quantity, current quantity, 2024, right? Real GDP, right? So yeah, in the 2024, right? We take the base year price into current quantity because in current quantity here, right? And the base year price 2020 multiplied by the quantity produced from the product B in the given year, no, right? So that is the constant GDP, no, right? We value the goods based on the base year, no, right? So we take from the base year onward, price level is constant, no, right? So there is no price changes reflected here, no? Price differentials are not there, no, right? Inflation we remove, no, right? Inflation, that is the real GDP. No, right? So now how we calculate the GDP deflator? GDP deflator. GDP deflator. implicit price index. We take the nominal GDP. If we take we are calculating the deflator 2024. We take the nominal GDP divided by the real GDP. Right. This divided by this. Right. So that means PA QA 2024 plus DB QB 2024 divided by constant DB. Right? You can calculate the GDP right? Okay. So that is the real GDP. Now this is the base year prices, right? So now other thing is if you have now if you think the how we can calculate the real GDP if you have given the information, right? Real GDP. We have the current GDP, nominal GDP divided by the price index. You can use any price index, right? To measure the real GDP, right? You can use consumer price index, wholesale price index, or GDP deflator, right? Price index, nominal GDP divided by the price index. You get the real GDP, or GDP at constant prices, right? Right? Right. So that is the real GDP. This increase in the real GDP compared with the previous year, no? Right? If we value that now, we can measure the economic growth. Right. Okay, right. Now you can see here, right? So the GDP constant, the real, and the GDP different. Okay, right. So now normally we use this national account, right? Right? Measures, right? Normally we can what is the code from there, right? National income accounts. Why we measure the national income according to this GDP, we measure GNP, right? House price, price, right? Market price, factor price, right? Together with goods, right? So we can actually measure the status of the economy, right? Or sales, right? So in order to have an idea about the status of the economy, once you get these statistics, right? You will get the understanding about these our level structure for the status, our income level, and so on. And we can see the progress, not by analyzing over the years, not right? What sort of progress is there? Right? So if we analyze the GDP figures and over the years, GDP, right? You can have an idea of the progress, right? And even you can compare, no, right? For the comparison purpose, right? You can compare with other countries. You can assess our level, right? Then we are in far below or above, right? The income is sufficient or not, right? Compare the calculations and we can measure the progress, right, over the years. So that also we can see whether there's improvement over the years, right? By comparison. So those are the things, right? And some issues are there, right? You can think about this non-monetized measure, right? When we are incorporating national income accounts, right? So we take into account all the goods and services produced, right? But some of the things are ignored, no? They are taken into account, right? So we are going to not value things no, in monetary terms, like leisure estate, leisure people. In the day, I'm going to and the national income, no, we are not going to. Right? And the quantity of inputs used, we are not going to take into account, right? Degree of resource exploitations, right? So we are not going to take into account, right? Sometimes growth GDP can be increased by exploiting the resources, right? And the labeling, right? Exploitation. And we are not going to take into account the social, environmental effects, no, right? Pollution, right? That's we need to take into account the sustainability to get the growth, right? And the informal economic activities, no, right? So much of activities took place in informal way, right? We are not going to take into account. Even in the real sector and the monetary sector, you know, informal transactions, right? Unorganized sector. So sometimes we produce not for the market, for our own consumption, right? We are not going to do that. And underground illegal activities, no, right? Those things are taken into account. And we are not, whether we are valuing the domestic economic value of domestic work. No? Sometimes we accelerate the growth, right? So we are not taking into account the real economic value in non-domestic. Sometimes if we can increase the production, let's say, by cutting down the trees and something, agriculture, something that's, but we are not taking into account those, right? So there are some issues there, right? Weaknesses there, right? Some of the things are we are not going to include, right? Even though it's effective, right? We are not going to value the things in proper way, right? So, and also some negative effects coming from these things, right? We are not going to take it. So those are the issues in the national income, right? You can think about all these things. Right. So we are coming to the next one, right? So I think no. Okay. Right, next time, please go through these things. I will come to next time. National income, I am just go explain the things and some of the important things, right? So you know the national income circular, so right? You can refer that one and when you are coming to the next slide, right? Okay. With that, we hope to complete of the session, right? So